Markets do not move based on headlines. Most investors spend their time chasing surface level splashes, but breaking news is just a late visual reaction to a deep water shift that's already occurred. Today, we pull back the curtain on traditional market commentary to deliver a true macroeconomic analysis using a much more powerful framework, the mapping of capital flows. While the herd is distracted by daily economic noise and media panic, the real money is made by understanding the underlying financial currents carrying the economy forward. Hello, my name is Daniel Young, and this is Adapted Perspective. Every week, we separate currents from noise and opportunity from fear using an income focused strategy in closed end funds. It's not polished, it's not scripted, and it's definitely not herd thinking. We don't chase headlines, we navigate markets. Now, let me be clear, I'm not a financial advisor or a fiduciary. I'm an income hunter, a strategist who filters the noise, follows the data, and targets durable cash flow, even when that means taking a different course. In this Sunday's briefing, we dive deep beneath the surface to break down why the core drivers of capital haven't changed and how the new Federal Reserve strategy impacts your portfolio and how to position your income strategy for long term growth. Let's look at the data. 3 weeks ago, we mapped the six major financial currents shaping today's market. 2 weeks ago, we discussed using NAV, or net asset value, as the final filter of a longer final snapshot list. And last week, we detoured into the foundations of our country and how the creation and maintenance of those foundations are essential to our financial freedom journeys. This week, we're back in the water. Interestingly, after 2 weeks ashore, the radar hasn't changed. The headlines and noise have changed, but the currents are still the same. And that's my point. Markets don't move based on headlines. Headlines showcase surface noise that's a visual reaction from something that's already occurred. If we're moving based on the headlines, we're out of the current, thereby missing the event that's causing the headline. So I'll say it differently. The six financial currents flow regardless of how the surface looks. So let's look at the action, not the reaction. Imagine you're bay fishing. From the boat, all you can see is activity on the surface. And you're targeting the surface activity because it helps you catch bigger fish. Bait fish are swarming a shrimp boat. Small fish are darting everywhere. Dolphins are chasing shrimp and fish. Seagulls are going after everything edible. Sea foam and debris is everywhere. The feeding frenzy is chaotic. It's actually a pretty fun thing to watch. But none of that activity started on the surface. Something happened much deeper. A giant net pulled through a deeper current and churned up business for all involved. It brought a bounty to the boat and a feast to everything else nearby. Predators large and small responded to the shift. The water changed and the action started. The frenzy you saw on the surface is the continuance of what started below. Everything left floating in the wake of the end, or everything left floating is the end result. And you, the fisherman, are looking for the chaos because you know you can catch bigger fish chasing the same action. The stock market behaves the same way. Everyday investors chase the splashes. They react to headlines and inflation, jobs, politics. One company beats earnings, another misses. All of that is surface event. The real story is always flowing underneath. And if we look beneath the surface this week, nothing has really changed. The dominant current is still bonds and bonds proxies. Why? Because bonds finance expansion. Every new AI data center, manufacturing facility, utility upgrade, infrastructure project, all of it requires capital. Companies could spend cash, but they usually finance expansion instead. Borrowing preserves capital, improves cash flow, and often provides tax advantages. That's how businesses grow. The cheaper money becomes, the easier expansion becomes. And that's why interest rates matter. Not because lower rates magically make stocks go up, though they do certainly make us all feel better. Lower rates reduce the cost of financing tomorrow's economy. And this is where Kevin Warsh enters the picture. I don't expect miracles to happen. I didn't expect him to cut rates on day one. It would have been nice, but I do believe he'll respond to the data rather than the ideology. The previous Federal Reserve often found itself reacting after the economy had already moved. Warsh has repeatedly indicated he wants to avoid making the same mistake. But until he has the data, the economy isn't stopping. Businesses aren't waiting, they're moving. Apple and Intel both just announced a new wave of American investment. Capital continues to expand, and our currents continue to flow. Meanwhile, herd investors are waiting and watching the surface, looking for what they think is the easy score. While they wait, the news media shifts from one fear to the next. Inflation, politics, jobs, oil, international news. Tomorrow it'll be something else. The topic always changes, the pattern doesn't. That's why I spend far less time asking what are today's headlines and much more time asking instead, where is capital actually moving? Because that's the current that will still matter next month. And with that in mind, let's move into this week's closed-end fund snapshot and look at the funds positioned inside the strongest actively flowing financial currents. The top four remain bonds and bonds proxies, real estate, end-to-end energy, and the technology family tree. So let's look at this and see where things are. So this is the final list, and I get that it's lengthy, but it's not actually the ultimate final list. It's 9 funds. So they're all tempting and for various reasons. In my content card expedition or endeavor continues to grow. So of the full list, we'll get into that first. Everything's a target, outright triple asterisk target, except for IGR, which just remains a great dollar cost average pickup for me. If I was buying it in the Roth, I wouldn't buy it because it doesn't fit the narrative or it doesn't fit the parameters. Buying it in the cash brokerage, it fits simply because I already own it. So they all pay monthly. Let's see, they're all discounted significantly except for IGR. They all pay monthly and they all fit into those four financial currents. You've got real estate, just an overall high income vehicle. This hits multiple levels. PHK is a bond fund. Then you have bonds ish, uh, real estate, real estate, and a preferred slash energy fund. So they all fit the bill. Ranked by yield, these three are below my normal 9% threshold. The reason why they're here, PDT has a growing dividend that was a lower dividend that just got raised. RFI pays just a consistent flat out dividend day in, day out, or month in, month out, as does RQI, although they just raised theirs a little bit. But all three have the potential to pay hidden yields, or say yields that are not always there. And they seem to pay them with lower interest rates. So of this list of 9, I went back and looked at that NAV data and I crossed out global real estate, the overall high octane vehicle, and DOY. All have, if we look back at 1 year NAV data, they all have just eroded NAV over the last year. If we also use the same data to look at HGLB, PTY, and PDO, their NAV data is pretty consistent. It's gone up or down, but if we look at it year over year, it's pretty much a flat line, which is much better than loss. But there are 3 funds that have significant growth in their NAV value, but they also have significant distance between the net asset value and the price, or what you see as a widened discount. And it honestly presents me a problem. So, of the original nine, the bottom three are the best buys. Um, and I've worked like the last couple hours I've spent on how I would say this. It presents me with a unique problem, or maybe not a problem. It just presents me with a unique opportunity. Uh, in the past week, as I updated my portfolio today, I noticed that a fund was sold in my Roth, uh, not by me, but Aberdeen bought a fund in my Roth. CIF was bought out by an Aberdeen fund, which I believe is MMT. I just saw that today. And I looked at MMT, and it has a crazy variable dividend payment. Pays okay, not great, but not. I mean, I'm not. I've said this before. I'm not an Aberdeen fan, and I dislike variable dividend payments. Um, and it breaks. It looks like it breaks the overall style of what I'm building. So chances are I will sell that fund for whatever it's worth and just pocket the what well I don't know if I'll pocket the profit, but I'll just pocket the money. The other thing I'm at a point where I'm ready to sell OXLC. I still think private credit fears are way overblown, but in a the market I still believe is moving to a lower interest rate cycle, and that just doesn't help OXLC. I love the dividend. It used to be better. I love this price. I really loathe this price. And as much as I've read and I think private credit fears are overblown, that doesn't reflect the current tenor of the market. And that doesn't seem to be changing much. So uh, no one loves losing money, but it's just it's oh, how do I say this? No one loves losing money. It's a potential of investing in the market. I mean, the goal is to have many more wins than losses, but occasionally you're going to lose money. The goal is not to lose it, but occasionally it happens. In the Roth, it just is. I lose money, but whatever I sell it for gets recirculated along with that value from MMT, and then I would buy something else. I would do the same in my cash brokerage. And yes, this is actually my portfolio. I haven't done a portfolio video in a while, but this is actually my portfolio or our portfolio, I would say. Um, and it's fairly up to like, well, everything is up to date. But I'm finally at a point where I would sell OXLC out of both portfolios. So I have that cash padding if I wanted to buy it tomorrow. But the three at the bottom of this list present me with a unique opportunity. So I had an interesting conversation with AI today, which I'll probably share in a different video. Um, in both real estate and utilities, uh, I don't know. I have people would say I have a well diversified portfolio. I don't really look at it in diversification. I don't look at diversification quite that way. Uh, I'm trying to build an income focused portfolio in both accounts with slightly different angles. The cash brokerage just allows me to invest in short term opportunistic funds that I'm trying to get away from doing in the Roth. When I started the Roth, I didn't have control of the cash brokerage. So the Roth was doing two different things. But now that I have control, which sounds kind of crazy, but now that I have control of both funds, I'm trying to repurpose both funds and make the Roth more consistent day in, day out, which I honestly put at the top of the Roth as a reminder to me. But it's there for you as well. I want I don't want roller coaster buying. I don't want crazy aggressive, crazy risky. I want relatively boring funds that pay day in, day out. Now, my version of boring and setting a 9% or better threshold with some exceptions might be too aggressive for you, but it works for me. Um, and the cash brokerage has a little more leeway where, given the right situation, yeah, maybe I would pick up OXLC again. But it's got a more widespread look of funds that isn't reflected in the Roth. So I say that because RFI is an unleveraged fund. It pays day in, day out since they went from quarterly to monthly. It just pays a 0.08 dividend every single month, regardless of what happens. And it does it unleveraged. So there's not a lot of swing in value and there's not a lot of risk. That's great in the Roth. That's not exactly the angle I like in my cash brokerage, which I'm more of a opportunistic income hunter in that sense. So it presents me with an opportunity. I like RQI. I mean, RQI and RFI, it's the same portfolio, pretty much. The difference is the leverage in RQI. So you get a better long-term payout. And between the 0.08 and the 0.09 dividend at 100 shares, it's just $1 difference, right? If we're looking at things, there's just $1 difference in dividend for a month, which gives you $12 difference for a year. That's not a lot of money unless you're compounding it over time. Uh, their price swings relatively the same. I mean, it's the same portfolio. You're just getting a leveraged amount versus an unleveraged amount. But with its current discount, it doesn't generally sell for this discount. So you're getting a better fund uh, or access to a better fund because of the wider discount. So that's appealing. Um, I so for my portfolio, I would leave RFI in the Roth as is, but I'm looking into the option of selling RFI in the cash brokerage and doing something else. That could either be buying RQI, could be buying RQI and PDT. PDT it's a hybrid fund. It's an energy fund. It's a crossover fund in a lot of ways for me because I own different energy and utility companies already. If you looked at it just on surface value and looked at all the different energy funds I own, yes, you would say it's redundant and doesn't really make sense in the grand scheme of things. But I see it as not a long-term product, more of a short-term, cycle-dependent acquisition. Yes, I'm building a durable income portfolio, but at the same time, I'm not afraid to cycle funds. Now, all of us hate change to a degree, and I would wager none of us want to fully revamp a portfolio. But in the nature of investing, the goal is income, and I hunt income. And sometimes that's stuff that's going to stay in the portfolio and just be there, right? And hopefully never change. But if it had to change, I would change it. The other stuff is very cycle dependent. I have funds labeled LT long term. I have funds labeled life. I have funds labeled short term. But every life fund is still at, we'll say, is still not off the chopping block if the market truly changed that much. Uh, if we truly cycled away from bonds and the bond market was predicted to crater, it would force some significant changes on my end, or at least some very specific and significant self-contemplation of and evaluation of the portfolio and the overall strategy. But the goal is not to be caught that flat-footed. So I like PDT in a short-term sense. It would I don't think it would. Well, I like PDT in a short-term sense as a preferred energy fund that works great with bonds. When the current shifts, it's hard to justify keeping in the portfolio versus RQI is, yes, a bond proxy, but if the interest rate market really shifted higher, like higher rates and preferred rates just don't get along, PDT would drop off. And in a higher rate market, RQI could still generate an income because that's how real estate works. They're they're targeting US based, which I like a closed system in that sense. It's got very little international involvement, like it, unlike IGR. IGR as a global REIT, you're going to see volatility or just up and down of the price, which bothers some people. It doesn't really bother me. Now, I don't like seeing my stuff go down, right? But IGR just pays the consistent dividend, and it's a consistently fat 15% dividend right now, which is amazing. And it's a great dollar cost pickup because of that. But again, I wouldn't buy it for the Roth because it doesn't meet the parameters of the system. As crazy as the 15% dividend is, it doesn't meet the discount parameters. So on the cash brokerage edge, if I'm looking at RQI and PDT, PDT is a great short-term pickup, and RQI is a great short-term pickup. The difference is if the market swings back into a higher rate, which currently we're at steady rate, I think we're shifting to lower rate. That favors both PDT and RQI. But if we swung back into a higher rate or a fluctuating rate, then that leans more toward RQI than PDT. So it presents an interesting conundrum. It presents an interesting possibility where I would actually go through it's not a hassle, but I would go through the hassle, not so much of selling of RFI, but of updating that much of my portfolio to sell RFI, to buy RQI, and then debate about picking up another 100-ish shares of PDT in the process. And I don't know if I could do that because cash brokerage wise, I would sell OXLC, and then I would sell RFI, which I don't have a ton of shares of RFI, but I would sell the 200 shares of RFI. I would sell OXLC, add that to the existing balance I have, and see what I could buy with it. See how much of whole shares of RQI I could buy, and then if it left me enough money to buy another 100 pack of PDT. And the Roth fund, I would keep RFI because it is that unleveraged day in, day out payer. And I would sell OXLC and I would sell whatever CIF turned into and see what it left me. And I don't know what I would buy. I would maybe buy more of RFI because of the current discount, or maybe I would buy something else. Maybe I would buy PDT for the short term pickup. I don't know, but that's a different problem. So for of what I'm offering or what I'm reviewing now, I'm going through my options with you. Of the cash brokerage, that's pretty much my game plan. Of the Roth account, I've got some more thinking. And it goes back to this mandate, all weather, no withdrawal, any economy portfolio, actively managed by me, but mostly as set it and just let it be. Uh, with bonds and bonds proxies. So no roller coaster funds, nothing crazy aggressive on my end of things. Stick with pretty boring. And the set it and forget it fits much more on the RFI side of things than it does the other two. Would I be willing to get into short-term cycling? I don't know because I'm trying to get away from that. I'm trying to build the Roth. It's just it's there and it grows and it churns out money and that's great. And then I let the cash brokers do the other stuff. That's maybe not the I don't want to say safe because I don't consider what we're doing safe. Uh, but I guess you could say that's my internal protection to where the Roth has a function. Its goal is, we hit the certain age and then you can, whether you cash that out or take monthly payments, but it churns out money. Uh, and I'd much rather house risk, which it's all risky, but I'd much rather house the majority of the risk or the up and down of things in a different account. Uh, And maybe that's not the best way to say it, but that's at least the best way that it's tracking in my head right now. So the final list is a list of nine, but using NAV data, three of those funds drop off, or actually four of those funds. Is it really a list of nine? It's a list of nine. One, two, three, four funds drop off. One, two, this does not make, this math is not mathing. It ought to be 369, but it's not. Um, at any rate, uh, let's see. These four funds drop off. That leaves us with three funds still on the list. There we go. And then these three make the list. So three are decent buys, three are better buys, simply based on the NAV data. So take it for what you will. The final list is a list of nine, but using the NAV to sort the rest of the data, it really drops off to a list of three. So I leave you with this. Most people invest by reacting. Successful investors learn to recognize structure and chase the deeper layer. What happens on the surface isn't meaningless, it's just simply late. And by the time the headline explains what's happening, the deeper currents have already carried capital somewhere else. And our goal isn't to predict every wave or ripple. It's to understand the current well enough to let it carry us forward and know when to switch currents. That's why we study capital flows instead of headlines. And that's why we position ourselves inside the strongest financial currents instead of chasing yesterday's surface winners. And that's why, while much of the market is still watching the splashes on the surface, we're already moving with the water beneath them. Now, remember this, I'm not here to tell you what to think. I'm I'm here to tell you it's a double-edged sword. I'm here to tell you what's on my mind as I look at the market. But even then, I'm not here to tell you what to think. I'm all about you learning how to think. So if you're willing to dig deeper and dive below the noise, you'll begin to see the market differently. Today's events matter, but the currents that produce them matter even more. You'll read the headlines, but the headline, if you're willing to dig deeper, you'll read the headlines, but the headlines won't dictate your decisions because you'll understand what produced them. You see, navigating the market never gets easier. It's a constant battle of wits, a continual checking of the sails, your heading, and the water around you. The currents, waves, ripples, and tides all change. The weather changes, the stress changes, and as you go, you change. You get better at reading the water, adjusting your course, and navigating the ship. And that's when and how your investing ability changes. And that's the growth I expect in a fellow captain. That's all I have for the week. I wish you an amazingly successful week. I hope you get stuff crossed off on the to do list. I certainly have a lot to do myself. So, whatever you have planned for this week, whatever you hope to have done by next week, I will see you next Sunday. And I wish you all a wonderful week. And if you, by all means, if you have any comments or feedback, just post them below. So have a great week, everybody. See you later. Bye bye.